Hello and welcome to India Market Open. It's been a very volatile week. Lots of factors that are playing havoc with the street. We'll take you through all that and more over the next couple of hours. Of course, the first hour gearing you up for trade, but we have Niraj back from a very exciting conference. Thing on his bucket list, the top list, and Tamanna has been holding fort while we've both been away. Yeah. I have not been, of course, in the US.
Yeah, if you were there, you would feel that there is only one thing to do in life, and that is to invest. And well, Buffett is epitomizing that. But be that as it may, India clearly is a different kettle of fish altogether, and a lot of nervousness, a lot of jitters, and volatility out there.
Completely. I think all the action over here in the last 3 or 4 trading sessions, with the market trying to find its feet and understand what's happening next. And that's really what we're going to break down. More than what's happening worldwide or global cues, Indian markets now grappling between, I would say, the quantum of foreign fund flows and waiting for June 4th. I think that anticipation has come in, that what will 4th June bring. I don't know what you guys think, but it seems more like looking for a reason to actually perhaps pull down positions ahead of June 4th, or looking for triggers to sort of panic. Because at the end of the day, and let me just quickly address all of the chatter and talk over the last 24 hours. Will the NDA come with 400? Will it be 320? My point is, anything over 272 is what matters. At the end of the day, if you have to form a government, you have to run a government, you have to make policy, you need 273. So during an election, political sloganeering is a whole different kettle of fish, right? Yeah. You say 400, you can say anything actually, because that's part of campaigning. At the end of the day, is there any real data or concern about whether you're going to have an upset? We don't know.
Yeah.
3 phases of polls, so we don't know yet. But nothing really has changed on ground, except a lower voter turnout, which could be for various reasons. And of course, we'll talk about that more ahead on the show.
Yeah, and I think it's everything else that's coming together as well, right? The fact remains that earnings were not very impressive, to say the least. I mean, no one's super excited about it. India still is an expensive market. China's trade seems to be back on. The VIX has seen some rising, and historically, while the outcome on the election is almost a given, FIIs historically prefer buying at a premium post an outcome as opposed to preempting an outcome. And that's what's playing out. And we've talked about this at length. And let's not forget that Nifty is priced to perfection. So any sort of negative news flow is going to disappoint the street. And that really is what's playing out. So it's nothing to be worried about, but there has been basket broad-based selling. The VIX is up over 30% in the last 4 days. And let's not forget, in the preceding month, we saw the VIX decline substantially, historical declines ever in the first week of May. And now we are seeing an historical rise on the VIX. So it's wild swings, but I think that's par for the course.
Yeah. So we'll break that down in more detail ahead in the show. But let's start with the global setup this morning and how that side of things is working out. So our 5-day winning streak continued pretty much on Wall Street, at least for the Dow. No massive gains, but in closing in the green, so in positive territory. The focus continues to be on corporate results coming in, the jobs data last week still giving some hope to the markets that you would see Fed cuts at least this year. It's a scale right now. If you're very, very optimistic as a Wall Street investor, you're looking at possibly 2 Fed cuts this year. If you're negative, then you're like Neil Kashkari, the Minneapolis Fed chief, who's saying that maybe not this year at all. And if you want the Goldilocks scenario, not too hot, not too cold, you're looking at possibly a December. So that's the large, broad sentiment in the US markets. And Neil Kashkari, important comment from him, he's usually hawkish, and he said that rates may have to be kept steady for longer. So that's a cue that will be taken as well. Bond yields, on the other hand, continue to remain okay at 4.53. On rate cut hopes, but remember, it had dipped below 4.5 as well. So no big movement there. Neither on crude, to be honest. It's a wait and watch, because there was an attempt at a ceasefire. Hamas accepted one version. Israel has rejected it, continues its operations in Rafah. So no clarity if anything is happening there. So largely unchanged on the WTI and the Brent. no big moves on crude that have been seen. Asia, meanwhile, has a mixed kind of an opening following cues globally. So suffice to say, no clear direction coming in globally either. Just want to get to the implied open and just set up what you're going to see today, perhaps, and there you have it. Maybe positive, slightly up in the green. Yeah.
You know, one thing that I have been thinking, both of you will agree, and this is the wild swing when we talk about the Fed, right? We talk about a Goldilocks scenario, and in the same breath, you have analysts talking about stagflation. Both of them are extreme ends of the spectrum. There are people talking about a rate cut, there are people talking about a rate hike. It's almost tough to read into what the median really stands at. And looking at Asia, and I think that was an interesting reading, see the way Japan is falling again this morning and see the way Hong Kong is actually rising. So what we found interesting is that it could be that China trade is back on. Hong Kong has seen its biggest winning streak since 2018. And this comes in at a time when Chinese markets have been closed. So what this means is that it's foreign investors that have been aggressively buying into China. We've talked about how this is not going to have a huge impact on Indian flows, but will definitely eat into the piece of the pie from Japan. Remember, FIIs were flocking into Japan and Taiwan for the love of semiconductors. That has been seen weaning off after a few disappointing earnings that came in from Japan, and that led to a massive sell-off across those markets. So what your foreign inflow was really doing is dumping Japan, moving the diversification into markets like China and Hong Kong. The other thing that we also did realize is that after Japanese yen has declined very sharply, the returns for 1 year for US dominated ETFs or Japanese funds is only up 8% versus the market in local currency being up 14%. So lots of negatives playing out for Japan, which seems to be China's gain in a big way. The People's Bank of China has come in with a huge stimulus package. We've talked about this extensively over the last couple of days and weeks, actually. They're looking to boost their real estate market. They've talked about shanty redevelopment, urban village development. All those factors is what's actually boosting inflows coming into China. Also, what we noticed was the money coming into China right now is sticky money. It's mutual fund money as opposed to easy money that's flowing into those markets. For what we can see, Niraj, Tamanna, both of you please weigh in, is that this is eating into China, eating into Japan's inflows. What it's doing to India, tough to tell at this stage, but historically, India's always given a piece of the pie when China starts looking good. While these markets are mutually exclusive of each other, I'm not sure whether that may continue for the foreseeable future, at least in the interim, given where we stand as well, right?
I think the delinking has begun and will continue, where assessments of India will be made independently. Also, think of it this way: everyone wants to sort of, balance your risks, and India is a different trajectory and a different story, which I think time and again now has been proven over the last few years. So I don't know if it's going to be so much of an either or. At least that's my take.
No, not too much.
No, nobody discussed this in the US, is it?
No. Everybody's talking about how inflation is unlikely to come down. Just look at the wage rates and the consumer spending, and it's something else out there. But anyways, let's move on. It's 8:07. A quick trade setup and then the stocks to watch in this session today. So for the day, I think Samina's kind of highlighted the volatility issue as well. But India VIX up for 9 straight sessions at the highest level since 2023. Tells you what's happening in the market, really. And it's very difficult to shrug off this volatility, I presume, until the opinion polls are out. Frankly, who is to come and say that, oh, this cannot be there and this can be? The market will think what it wants to think, to be very honest. What we can talk about is data, right? And Sensex revenue and earnings growth thus far, as of yesterday evening, is at 10% and 12%, which is marginally higher than what was estimated. Actually, on the earnings PAT growth, much higher than what was estimated. So that is actually a positive, if you will. The two things that stood out, and one, yesterday SRF was symptomatic of what's happening in the chemical space. The PAT performance has been wobbly, and the commentary is still clouded. I think we'll talk about Navin Fluorine as well in a bit. But I think there is an issue out there that while there was some bottom fishing happening, thinking that China reviving will help chemicals, I think the commentary thus far is looking very clouded. And lastly, metals, the Morgan Stanley note on steel today was outstanding, wherein they are, as in standing out, wherein they are saying that the current valuations at 1.8 times price to book versus long-term averages of 1 time look unattractive, and this space could derate over the coming months simply because there is just no material improvement in inventory levels and spreads. So while everybody's been rah-rah over China uptake and what it could do to metals, clearly inventory levels don't show, spreads don't show that, but valuations show that. I have a clear case of whether, asking a question whether valuation should come off. So that's an interesting bucket to my mind.
Yeah, well, that's largely what we're expecting. Today as well could be another morning where the street will consolidate the negative bias. It's tough to call these things, but yeah, you could see some low-level buying, but the fact remains there is nervousness, jitters, whatever you want to call it, on D Street, and extremely volatile trade that we are setting ourselves up for. Nothing out of the ordinary. That's the other thing you want to be mindful of. A few stocks that are on my radar this morning that we'll quickly highlight for you. JSW Energy reported numbers. Those numbers on the face of it look pretty phenomenal, actually, to say the least. The margins have improved to about 43% versus 28% the same quarter last year. Revenues were up slightly, flat to slightly up, about 3.2%. EBITDA was up 58% to come in at 1,178 crores versus 745. And their profits were also up about 22.5%. Mixed views coming in from brokerages. So while you had Citi that maintains a sell on JSW Energy, they've raised the target price to 435, which is a 25% downside. Jefferies, on the other hand, continues with a buy on JSW Energy, and they've raised the target to 690. Citi, of course, says that they maintain a sell on higher valuations, and also have the fact that they want to watch out for is execution and whether or not the new order wins could, of course, come in at lower margins. So they bid very aggressively. That may impact the very healthy-looking margins at this stage. So JSW is one you want to watch out for. Pidilite and United Breweries, good set of numbers from both of them. For Pidilite, revenues were up nearly 8% at 2,902 crores. EBITDA was up 25.6%. Margins have also improved to nearly 20% on the upper band of what we've seen for Pidilite versus 17%. Net profits was up marginally. So this one could be one you want to track in morning trade. Not too many brokerages commenting on it just yet, but of course that will flow in as we go along through the day. United Breweries, again, I'd love to know what's going on, and we'll talk to the management on back of these numbers, but the revenues were up 18%. EBITDA was up 166%. I'm guessing there was an exceptional item on that one at 143 crores versus 54 crores. Margins have also improved substantially to come in at 6.7% versus 3%, and net profit was up 730%. So very obviously at 81 crores versus 9.87 crores. So it could be outside core business that's pushed up the earnings for United Breweries. The management will be talking to us at 10:30 a.m. and we will get a sense of what led to such a good reporting from them this quarter.
Yeah. I just want to start, and of course we'll get to some of the results coming in, but I just want to start by putting the focus on the set of consumer companies that have been the star of the show the last two trading sessions of this week, Monday and Tuesday at least. And what would be interesting to watch is if that holds up. So if it was a Britannia leading the pack on a Monday, it was HUL on Tuesday. Among the Nifty companies, Marico, Godrej Consumer, that entire set. Now, quite a few notes this morning talking about how the hope is that volume growth will come in, and Q4, the end of Q4, is seeing an improvement in rural demand. Nielsen data also out yesterday talks about an uptick in rural demand. The question is that, is this merely a rotational play, or will you see now a sustained turnaround in a set of companies that have been described by one expert we spoke to as unloved? So FMCG companies is one that I would definitely watch, and you might see some interesting moves over there, perhaps a pullback in some of those stocks as well. The other one, of course, is Dr. Reddy's. Numbers out, and numbers slightly below expectations, I would say. Now, I was just looking at Nuvama's note on it, and their concern is that the core business EBITDA margin is below 20%. at 17% actually. If you remove G rev limit and the concerns of that start in 2027. So there's a decline of about 250 to 300 bips there. The R&D spends at 10% of sales long term is of course a good thing, but they expect that to continue at a higher level at least till FY27. So it might impact revenues there as well. It's all towards a new suite of drugs called Horizon. So we'll have to wait and see how that turns up. But that is going to be an impact. So Nuvama has maintained a reduce and a target price at 6258, which is pretty much where the stock is right now. So is there really an upside? Could you see a bit of pressure in Dr. Reddy's this morning? It's possible you do. Navin Fluorine is the other one. Niraj referred to it briefly. So as expected, revenues down, EBITDA down 45% year on year, margins are down, so are net profits. Now the whole question about this space is what is the outlook for improvement? And management commentary so far is looking at a gradual agrochemical recovery in FY25, but more pain may be in store for this space. And that's a point that you made, Niraj, that the light is not yet visible at the end of that tunnel. It's there, but it's not yet visible.
Yeah, and for Navin particularly, I mean, CDMO is now a big part of their business. That number in Q4 was only 48 crores versus 208 crores YOY. So you know where the pain came in. You heard Loris and Sinjin speak about how CDMO is only coming back in the second half. So Navin, very unlikely to see that. And for Navin in particular, the other issue has been they're not having a managing director. And thus far, they're saying that they're hopeful of onboarding a new MD soon, but no clarity on when that comes in and what the strategy of the new MD will be. So in some sense, a ship without the captain at its helm, a bit of a problem.
One small segue, but one recurring theme in this entire results season, I think at least I have noticed, is that the captain of the ship has become very, very important, whether it's a tech company or any sort of sector or a bank. What an Ashok Vaswani says or what a Mohit Joshi says makes a huge difference to the market and may even supersede what numbers you're presenting in Q4 because the outline is clear. So if there is no captain ruddership, always
case in
And
has a
I
problem.
think it's historically, when a fund manager, when you bet on a company, qualitative analysis, I think one of the top factors is the founder or the promoter.
Yeah.
So that
or the
clearly
CXO in this case.
becoming very, very evident now because there have been changes on that front recently.
IGL was the other one I just wanted to talk about, third stock, before I hand it off to Niraj for his first cut of his list. So IGL, again, not very, very great numbers. The Q4 EBITDA at 12% is below brokerage estimates, those base numbers on your screen. The OPEX has been higher. Volume mix has also been higher, not too great. It's led to lower margins. The industrial volumes are in line with estimates, and there is a partial impact of CNG prices that was felt in Q4, so that will be taken into account. I would assume you won't have a very great opening for Indraprastha Gas, but then it's a wait and watch to see what you're going to see. The one outcome from the management which caught my attention is that they're going to venture into the EV charging segment, but then that is one of those plans that we'll have to see actually play out before coming into any conclusion.
Yeah, well, so watch out for these three. 2 or 3 stocks, PB Fintech, and the con call is on right now, so what they say in the con call will probably supersede what they've reported, but total income up 23%. PAT up 62% YOY, but the point being it is exactly in line with what was estimated. So this total income, but the PAT at 60 crores, the Bloomberg estimate was 60.4 crores. We missed that, but the relative to what was estimated, they have reported just the exact number. The adjusted EBITDA margin is up 370 basis points, which is at new highs for PB Fintech. So they actually really did well. And the core business beat was largely led by strong insurance, new business growth. This is something that is welcome. So very likely that the stock will do well, but we'll wait for the takeaways from the con call before things get decided. And the con call is on, as I said, so that might supersede the reported numbers. Sonata left a bit to be desired. Revenues were down 12% at 2192 crores. The Bloomberg estimate was 2178 crores. So that in line, but EBIT margin at 5.03%, the estimates were 7.73%. PAT down 22% at 33 crores. The estimates was a very high number, very likely Sonata Software could see a bit of a reaction downwards. And Voltas is the other one, guys. The stock, along with all the cooling solution companies, saw a lot of fanfare in the build-up to the results, has had a really good rally in the last 1 month. The numbers on all counts was a bit of a miss. Brokerages are still constructive here, but the numbers are a miss in a wobbly market. Maybe you see a reaction. If you see a reaction, you know why that is happening.
Yeah, and also the massive run-up that it's already seen on the back of a hot summer, etc., etc. But it's not necessary that you are going to benefit as much as your other competitors in a hot summer, I suppose. That's the story for Voltas.
Yeah, we've got a bunch of other stocks, but I think we're clearly out of time. A quick mention on numbers. IRB Infra reported earnings that were slightly disappointing. Max Financial has also posted a huge loss of 50 crores versus a profit of 52 crores. So watch out for these ones. IRB and Max should be on your radar on the downside. Jindal Store, on the other hand, saw a good set of earnings. So they've seen a good margin expansion. Their revenues are up. EBITDA is up quite sharply, and profits are also up 62%. So Max and IRB on the downside, and you've got Jindal Store on the upside. That looks good.
I just wanted to talk about Jupiter Wagons for a second. Numbers look good. Your revenue is up 57%. Your EBITDA is showing a healthy uptick, 60%. Margins also decent, 13.2% versus a 12.9%. And profits up 167%. Now again, this is one of those spaces which will see perhaps a renewed interest once you have elections out of the way. The whole plan or the policy push for a complete overhaul of Indian Railways is a long-term one. It's not about 1, 2, 3 years, probably go on to the next decade. So Jupiter Wagons one to look out for. But the numbers at least don't leave anything to be too disappointed at this point. V was the other one. So Nuvama has maintained a hold. Citi had an interesting line to the effect that stars may be finally aligning for Vodafone Idea, and this is post a management meet with some analysts. Now, Citi is looking at a possible 15 rupee scenario for Vodafone based on two core things. One is that the ARPUs go up significantly, nearly by 60% in the next couple of years, that you would have those tariffs going up. And that's something the whole industry is betting on, clearly. And the second big one is that one of its large stakeholders, which is the government of India, continues to be quite benign. When their dues come through, the AGR dues come through, at least part of it gets converted to equity. So that's the push. You might see some movement on a Vodafone Idea this morning.
There's Dixon as well, by the way. I don't know if the Nokia announcement helps Dixon, so that's to be watched out for. And two brokerage notes which I thought stood out. One was, Samina was speaking about JSW Energy. The Jeffries note on JSW Energy is interesting. They have a buy call. The target price raised to 690 versus 600 earlier. And the reason they say is that the power demand recovery to 7% plus levels points to peak deficit pockets continuing, which might keep double-digit earnings growth visibility for JSW in the medium term. They have raised their FY25 and 26 EBITDA by nearly 10% apiece for both of those years, which is actually pretty strong to my mind. And the Morgan Stanley note on Concord, the only caveat is that at 3 p.m. yesterday, some people put out on social media that Morgan Stanley's target is much higher than the current price. So in some sense, yesterday's, maybe there would have been a bit of a move, but substantially high target price by Morgan Stanley on Concord because of freight rates.
Just so quickly on JSW, and I don't know if you've seen it, those margins, how sustainable are that? 42% versus 28% in the same quarter last year. So I'm not sure if they go out and aggressively continue to bid, those margins will be compromised. No, and so how have they managed to pull it off?
Merchant rates currently are going through the roof because of power deficit, and everybody who's got a little bit of merchant power sale, which JSW does, is actually benefiting quite a bit. So maybe not as much for a Tata Power, which is largely PPA, but everybody with a little bit of merchant power angle is doing really well.
A great day in trade, but yeah.